Good afternoon, ladies and gentlemen. My name is William H. Thompson, CPA, MBA, and I am the founder of RE Accounting and Tax Professionals. We help real estate investors maximize return on investment through expert tax strategies, while at the same time helping them to build and sustain a legacy. Welcome to Free Information Friday, and I'm excited to delve into the topic of tax consideration for home flippers. Home flipping can be a very lucrative endeavor. However, it's important that you know the tax implications that come along with it. So let's begin. First, when flipping homes, there are two ways that you can be taxed: short-term or long-term. What I mean by that is this: if you buy a property, fix it, and sell it within a year or less, it's going to be considered a short-term gain. Those short-term gains are taxed at your ordinary income rate, which for some people could be up to 37%. Pretty hefty. Now, if you're fortunate enough to hold the property for a day and a year, you will qualify for long-term capital gains, which are substantially less, ranging from 0% to 20%. So it's pretty important that you understand that concept. The other thing I wanted to point out is I want to make sure that home flippers are aware that every legitimate business cost that they use to generate the profit can be deducted. For example, renovation and repair costs, marketing and sales costs, closing costs, and even transfer tax. So it's important to make sure that you're recording every expense that goes along with the endeavor of flipping your property. So let me just highlight it with an example. Let's say that you purchased a house for $300,000 and you put $50,000 worth of total cost into it. That's a total basis of $350,000. Now let's say within less than a year you sold the property for $450,000. That's a $100,000 profit in a short-term gain. So if you're the unfortunate person who happens to be in a 37% tax bracket, you're going to pay $37,000 worth of income tax on that $100,000 profit. That's a big bite Uncle Sam takes. However, if you were fortunate enough and smart enough to hold the property for at least a year and a day, you're going to qualify for long-term capital gains. And let's say that you're an individual that falls within the 15% capital gains tax. That is going to be a $15,000 tax on the $100,000 of profit. Big difference from the $37,000 tax on the short-term capital gain. But you're not quite done yet, because as an active flipper, which is your primary business, you're going to be subject to the self-employment tax, which is Social Security tax and Medicare tax for both employee and employer. Now that tax is a total of 15.3%. On the $100,000 of profit, you're going to pay an additional tax of $15,300 for a total combined income and self-employment tax of $52,300. Now that's quite a hit on a $100,000 profit. It's more than half of what you made. So as a home flipper, you want to be well aware of how long you're going to hold the property and what tax consequences that will bring forth to you. You also want to make sure that you're recording every available expense that you can in order to bring that net profit down. It's extremely important. I can't emphasize that any more than I already have. So in conclusion, home flipping is very lucrative, but it can cost you if you're not aware of your tax situation or you're not recording all of your expenses. So be very vigilant on knowing both. Now, I hope this segment of Free Information Friday was helpful to you. And if you're a real estate investor who wants to maximize their return on investment through expert tax strategies, while at the same time helping to build and sustain your legacy. Book a call with our firm. And remember, only you can create your empire, but we are here to help every step of the way. Thank you, and I wish you much success on your real estate journey.